Hello and welcome to this week's edition of Energy Frontiers. I am Justina Okechukwu, and we say thank you to the African Energy Chamber for supporting this program. Let me walk you through some of the biggest energy news from here in Africa and around the world. The Organization of Petroleum Exporting Countries and its allies this week announced a push forward to November 30, the final meeting for the year, which was initially scheduled for November the 26th, which is now expected to be held online. According to delegates, the delayed meeting was related to disputes regarding a review of the baseline that reflects actual production capabilities of big African producers, Angola, Congo, and Nigeria. The OPEC Plus news upset the global oil market as prices pulled back Wednesday and Thursday, but started turning green in early Asian trade on Friday, as the market speculated that the group may not deepen output cuts next year due to dissenting African members. International benchmark Brent crude futures rose 0.4% to $81.71 a barrel, having settled 0.7% down in the previous session, while the U.S. West Texas Intermediate crude lost 0.5% from Wednesday's close to $76.72 a barrel. There was no settlement for WTI on Thursday owing to a U.S. public holiday. Russia's energy minister Nikolai Shuganov says the country has lifted its temporary ban on summer diesel following a rebound in the supply, which have saturated the domestic market and leaving stocks of the commodity 14% higher than when the ban was first implemented back in September. Botala Energy Limited, an Australian exploration company, has listed all of its issued shares on the foreign main board of the Botswana Stock Exchange Limited by way of introduction. The listing of Botala reinforces the Southern African country's position as an attractive destination for energy investments. Ministers from Mauritania, Senegal, the Gambia, Guinea-Bissau, and Guinea-Conakry were gathered this week for the MSGBC Oil, Gas and Power 2023 conference and exhibition, which was focused on strategies aimed at promoting growth for the entire MSGBC energy sector and its value chain. The two-day conference featured discussions and deals from industry leaders and ministerial panels on regional integration as a requisite for promoting trade and market access for Africa's energy industry, while exploring considerations for the expansion of Africa's domestic oil and gas markets. The fourth edition of the MSGBC Oil and Gas Power Conference and exhibition is scheduled to hold in Senegal in the first week of December 2024. And that was a snapshot of your energy news headlines. The International Energy Agency says the global oil and gas sector is well placed to scale up some crucial technologies for clean energy transitions. More on this in a moment. Welcome back. International oil giants such as Royal Dutch Shell and the British Petroleum may have to spend $35 billion every year until 2050 if they want to remain major energy companies. That's according to a new landmark report launched on Thursday by the International Energy Agency, which sets out a strategic plan for a fair, net zero aligned transition pathway for the oil and gas industry. Here is Fatih Biro, the executive director of the Paris-based energy organization, speaking at the launch of that report.
COP28 will be a moment of truth for the oil and gas industry. It will show whether oil and gas industry will be the partners of the fight against climate change or not. So simple in our view. So therefore, our first suggestion to the oil and gas industry is commit yourself in Dubai to reduce your own emissions from your own operations by 60% by 2030, which would put them in line, their own emissions from own operations in line with the Paris goals. So this is the first one, and I think this would give, if they commit to that, this would give an entry ticket to be part of the genuine partner in our fight against climate change. But I see that there is other role. We believe that part of the answer of the oil and gas industry would be that those industries embrace the clean energy economy emerging. So this is the second answer we suggest. What is that? When we look at today in a clean energy world, there are technologies which overlap with the experience, with the skills of the oil and gas industry, what they have been doing years and years, such as offshore wind, such as hydrogen, such as biofuels, biomethane, carbon capture and storage in some areas, EV charging. So these are areas that the oil and gas industry can make major efforts, especially in terms of their investments. So what my colleagues did, I think it was a heroic work, a lot of data mining. They have found out how much today of the total capital expenditure of the oil and gas industry goes to clean energy options. And the number is rather disappointing. Today, only 2.5%, only 2.5% of the total capital expenditure of oil and gas industry goes to clean energy. In my view, dear colleagues, this 2.5% contradicts significantly this share, this modest share, with the share of clean energy statements coming from oil and gas industry. And therefore, we suggest, again in our report, that if the oil and gas industry wants to be a real, genuine partner to address the climate change, climate crisis, it's a problem of all of us. We think this 2.5% by 2030 reaches about 50%, 50% as an aspirational target for the oil and gas industry. We are, at the IEA, we believe that the clean energy progress will continue with or without oil and gas producers. We hope it is together with oil and gas producers, but it will go even without them. It will be bumpier, the road, and maybe a bit more costlier, but it will still continue because clean energy progress is unstoppable when you look at the numbers.
When we return, we have an expert's perspective on the future prospects of Africa's carbon markets. Stay with us. This is Energy Frontiers. After years of steady slow growth, there are clear signs that the African carbon market is starting to take off. Ahead of the COP28 summit set to kick off next week in the oil-rich United Arab Emirates, carbon markets is expected to be high on the agenda, and some African leaders are hoping to capitalize on that. So I spoke to Manoj Sinha, the co-founder and CEO of Husk Power Systems, to help me drill down on this very important carbon conversation. Speak to me about what Husk Power Systems has been doing on the ground using the carbon market to support your mission in Africa.
Let me set some context. So I started this company, Husk Power Systems, in Bihar, India, 15 years ago. I was one of them who had access to some electricity growing up. And therefore, that turned into a lot of opportunities for me personally, while my own relatives and cousins grew up in darkness, and they did not get any opportunity at all as compared to what I got. So that really inspired me to start Husk Power Systems to really install decentralized power plant system and provide electricity in a renewable fashion, reliable fashion, and a sustainable fashion, which is affordable for the rural parts of the world. So that was the genesis of starting Husk Power Systems. So I'm one of them that had access to some electricity while my cousins didn't. Multiply that by more than 1 billion people, and that's how many people approximately do not have access to any electricity or some electricity in the continent of Africa. So that's why we started replicating our mini grids model for Africa market to power these people from the very beginning with 100% renewable and sustainable method, so that we are not adding any more to the carbon and still deploying electricity in an affordable way. So carbon plays an important part of our decentralized model that is 100% renewable, is reliable, and affordable for the people that we serve. And carbon emission avoidance, because of that method, is avoided from the very start. Unlike Global North, that started their journey with fossil fuels, and now they are trying to offset those carbon that has been accumulating for hundreds of years. So that's the key difference between what we do in Africa markets for the rural parts of those countries versus what we see in the Global North.
Now, with the increasing awareness of climate change, how are businesses like yours and others adapting to the carbon market opportunities?
So carbon plays quite a good or important role in bringing the commercial investments that is absolutely needed for us to expand over hundreds of thousands of mini grids in Africa as a continent. So if a project, in our case, what we do have is these mini grids that are 50 kilowatt in capacity to 100 kilowatt in capacity, and we can serve a community of 400 to 1,000 households and businesses in a decentralized manner. Of course, we need to replicate it hundreds of thousands of times to serve those hundreds of thousands of communities around Africa continent. To make these assets commercially viable and fundable, carbon offset, which is traded in the world market, plays an important role because it puts the return on asset above the threshold that then attracts commercial capital. We need to the tune of $100+ billion in order to replicate this model across Africa. And carbon offset and market therefore plays a very important role at it puts the return on asset above the threshold, which then attracts lower risk infrastructure capital, which is absolutely needed to replicate hundreds of thousands of times.
I love what you said there, but now let's talk about finance, which is the big man in the picture. What role can the carbon market play in unlocking capital for African investments?
Carbon market is quite important. So in particular, carbon market was developed through UNFCCC framework that took a lot of factor from Global North as benchmark. The first and foremost thing that we think is important is to benchmark what is happening in Africa or sub-Saharan Africa and benchmark that before applying verbatim what happened in the Global North, right? So that's the first thing. What I mean by that is a diesel generator in, let's say, Nigeria as a country emits a lot more CO2 because it is inefficient, it is running inefficiently, and that is very different from a very efficient diesel generator running in, let's say, Americas. So that's the first thing that needs to be done. Benchmark it for the market that it is being done for. Nigeria is an example in this case. And then come up with a carbon framework that works appropriately for Africa as a market. Then global north, if you look at the global north of Western economies, they have been emitting CO2 for hundreds of years. They really need to bear the cost or the burden of CO2 emissions that is much higher per capita than carbon emissions in Africa market. And that's how the price differential for carbon offset in Africa should be traded at least at 100% premium as compared to what it is traded in global north. That's the first thing that is needed for the carbon market to incorporate, which will make then commercial capital even more attractive to come in these markets that is needing, again, hundreds of billions of dollars to deploy renewable assets in order to electrify a billion people in Africa continent.
And that's the package of Energy Frontiers at this time. And we thank you all for watching. Remember to follow the program on Frontier Africa Reports website, like this video, subscribe to our YouTube, and follow us across all our social media handles as indicated on the screen. I am Justina Okechukwu. I'll see you next time.